Okay, how we looking?
Looks like you're good to go. You've got the room for the next 30 minutes.
Great, great, great. How y'all doing today? How's everyone doing today? Everyone doing well? My name is Chuck Williams, and I'm here to show y'all how to trade the market using market sentiment with methods called volume spread analysis and currency index cross-referencing. And that involves taking the indexes and comparing them one to another and trade opposite against one another. I am CEO of Print Money Traders at moneymakers.com, and I'm a
Hey,
chief
Chuck,
trader.
hang on. Chuck,
Huh?
take that mic back down just a notch. Take the mic back down just a notch. The mic volume just spiked.
Okay. Is it better? Better now? Is it better now? Can you hear me?
Yes, much better now. Go.
Okay, great. Sorry about that. All right, I'm a chief trading consultant for Smart Trade FX, and it's an honor and my pleasure to be before you today. I hope the information I'm about to share with you will be beneficial to your trading experience. I have a method, like I said, called the the print money traders method, and it involves CICR, VSA, and MPRC, which is mark prices of supply and demand in the market. The way the method works is we look at the 1 hour chart. Let me get you a slide so I can show you what I mean. Okay, you see this? This is the 1 hour chart right here of the New Zealand dollar, US dollar. Okay, let me move this over for you. Now, here, when you see price coming down and it's making these long, wide range bars, either going up or going down, that's an indication of price getting ready to turn against you, especially when it's on the 1 hour. And you're usually looking for a bar that has a range of 30 pips or more to determine if it's a wide range bar. At the same time, you're going to see a spike in volume like you're seeing here. And when that spike in volume comes, it's going to stop the market like it's doing right here with this red candle. And if volume is increasing, you should have a corresponding movement in the range of the bar. Notice how the volume for this bar right here, how wide this range is. Notice how small it is right here, though it rises above this volume right here. But then this volume is 20% higher than the volume for this bar. But the volume for this bar is 20% higher. So therefore, that's an indication to tell you, plus the long spike down here is telling you that buying is coming into the market. And when you see that, you then mark this area on your chart. Then you go over to the 5-minute, and this is what you're looking for, because on the 5-minute is where you're going to make your entries and your exits, because the market is about to go into what we call accumulation. Okay, on this 5-minute here, let's see. Yeah, this is the one I want. All right, on the 5-minute here, this is the area that we seen when the market came down in a wide range bar. Notice how the volume went up on this bar here. Then we get a bullish reaction. Anytime you get a bullish reaction after a wide range bar and a spike in volume, you know that the market is either going into distribution. Accumulation is when the market is buying up in a range like this before it finally takes off and start marking up. So here we have a spike in volume on this bar, wide range bar right here. So we call this stopping volume. We got a bullish reaction. So when this happens, you let the market go ahead and do its accumulation phase. Because if you don't and you try to trade this here, which sometimes you can, if you're that good, you will get caught in the whipsaw motion of the market when it does that. So we will wait for something like this, a no supply bar, which you see right here. And when a no supply shows up, that's letting us know that the floating supply in the market has been dried up. And how do we tell when it's a no supply? Because we have the volume that's lower than the previous two right here. But then you don't enter the market right when you see a no supply, because even though one can show up, more supply can, when the market try to move higher, it could be supply right above it, because higher prices bring supply, like lower prices bring demand. So we don't need no close below this bar here. If we get a close below it, then that negates that no supply, and we have to wait for another one sometime in the future. And then the next bar we're looking for is like this blue bar here, which is a bullish bar with a close above this no supply. And that's our confirming candle to tell us that the supply has been dried up out the market. Same as this bullish bar here is a confirming candle to tell us that the market is now stopping its downward motion. Okay, when we see that, we don't want a large spike in volume. You notice this was average volume, because it's right there at the lavender line. You see this is the average of the volume for this period in time. So it's right there at the average. So it's telling us that, okay, there's enough buyers and sellers in the market, but there's not no overwhelming sellers in the market while the market is trying to go up. That's trying to stop price from rising. You know, because if we see a large spike in volume, let's say volume spiked up to here or a little bit higher, then we know there's still some floating supply left in the market, and we would have to wait, because I guarantee you the market will be coming back down to test this area, which it does a lot. But you see how it went here, came down, it tested the area here, went up, came down, and tested to see if there's any supply down here in this area of demand. Found a little bit. This right here is like the shakeout part. These shakeouts usually come before you see no supplies or either no demands when you going into a distribution phase. Because what the banks are doing, they trying to hunt for people's stops to stop you out, because you did choose the right move. However, you probably entered the trade too early, which a lot of us do, and we usually put our stops right below the low of the market. Okay, so we traded this here, and we would get in, and we would, anytime you get into the trade, whether it's up or down, you trade it until the next support or resistance. Or you can draw a Fibonacci of the move and go to the 50 to 61.8 retracement zone. Either your choice. In any case, you're still going to make a large amount of pips where, you know, you will be profitable for today. And these are safe trades where you don't have to worry about. I tell you, about 90% of the time, if you trade in this fashion, you're going to be right and you're going to be profitable. The only time you will not be, you know, is when you try to go outside the rules. And sure, you may miss some trades sometime doing this, because a no supply may not show up, or a no demand bar, and the market just takes off in the direction that you intended for it to go. But you know, that's okay. You know, at least you ain't in the market too early, you know, or the market is going into redistribution instead of accumulation, you know, and you end up getting stopped out. Okay, let me show you how this works. All right, now this is where we entered, and this is the bar we profited on, right? And we entered down here, and this is the bar we profited on. And I'm gonna show you in this. See, this was our entry on the 5-minute chart, and this was the exit right here. Even after that, the market came down, which is, show you this little area you see right here, where it's coming down here before it takes off and go here, and that's this area right here. where it takes off. Then it drops again and comes back the next day. Let me see, 1, 2, 3, next 2 days, and it tests the same area again. You get another spike in volume, and the market takes off again. It gives us a little basin area right here because why? It's meeting an area of supply. Last time the market was here, we had this reaction to it. So we know that there's some more supply here. So the buyers had to buy up all of that floating supply there to carry the market further. And it even stopped again once it got to this area of supply before finally going up here and turning back around. And what you see again once it got there. Okay, let me show you something else. Accumulation. This is what happens when the market is going into accumulation. We come down, we get the spike in volume right here on a wide range bar. Then the market has no progress into the down movement, though we get in these large. So that's telling us that they're buying up the market. And look, when the market starts to rise, volumes start falling off. So that means you don't see no red candles here. So there's no floating supply in the market. Okay, the buyers totally fall off during this almost the start of the Asian session. This is when the market is the most quietest because you just say it's like 5, 6 o'clock Eastern Standard Time. So there's really no traders in the market, especially the banks and stuff like that. So the market start accumulating and accumulating and accumulating. It comes down again the next day during the European time and to knock people out of their stops. Volume rises, we get a bullish reaction. Market goes up, makes what's called what is called the automatic rally point. The automatic rally point is when we see stopping volume, market rises and then comes back down to test the demand area. This area right here, we call it the automatic rally point because that's the point that we need to get up to and get past where we find our no supplies and no demands when the market's coming down, of course. And we enter our trade and carry it up to the next area, which right here, 5618, or either up to the next support or resistance area. As you can see here, market played out just the way we expected by waiting for that no supply. But here I want to show you the importance of this 50 to 61.8 retracement zone with the Fibonacci. You get a swing in the market, whether it's down or up. And you see the market start to slow down or you get some stopping volume, etc. It is best that you fib that swing because the market is going to more than likely come back and be stopped at that area. You're going to find supply or demand in that area most of the time. But if the market come and you get a close, it's okay to spike above the 618 area, but if you get a close above it, that means there is nothing that's going to stop that movement in any direction that it's going in, whether up or down. In this case, it's going up. So if the market would have came up here, it went to the 618 retracement area, and we got a close even slightly above it, we know it's going to probably do this and then take off and go back up to test this area of supply right here. And as you can see, we get stopping volume, large volume, wide range bar, bullish reaction. Market goes up, forms an automatic rally point, goes all the way up until it gets here. Comes back down here to test the demand area, see if there's any more supply down here in this demand area. Don't find any, it goes up. But as you can see, it stopped and halted right when it get to the 50 in the 618 retracement zone. This is, ladies and gentlemen, this is a very important zone to pay attention to. Why the market respects it? Because most traders is using it, even the banks. Okay. Okay, here's something else I want to show you. Drawing your supply supply and demand lines. Okay, how do you draw these supply and demand lines? They're not support and resistance lines. Understand that support and resistance is different. This one you would call support. No, not that area. Distance. This is what we call resistance. This is what we call support. This is what we support. This would be resistance. And yes, this is resistance and this is support. But su supply and demand lines, or zones rather, are more strong than support and resistance area. I'm sure you've seen the market has come up to support and resistance areas like making double bottoms, etc., and blown right past it after the third touch. Because what happens is, in this area here, there was a lot of buyers already waiting. And then more than likely, there were the institutional traders waiting for the price to get down here so they can buy low and sell high. Okay, so when price touched here, all of them buy orders start being filled up and it stopped the market. Here we see our spike in volume to tell you how much ticks was going on in trading in this particular candle. Because the large institutional traders, they have to buy into the down moves and sell into up moves because they have so much volume in trading to do, that they can't just, put in buy and sell orders like we can, because that would cause the market to just shoot off in any direction that they're going in so fast that it would even undermine what they're trying to do, which is not let the rest of the world know what they're doing, which direction that they're going into, and they can't take the money out of your pocket by stopping you out if they do that. Plus they will be undermining the business principle to buy low and sell high if they do that. Okay, so they have like just say they have a block of about 5,000 US dollars that they want to buy right here. So they would put 500 here to stop it, because they can see the how much supply is left in the market right here, and they know it's only 200 sellers right here. Now they got 500 worth here, so that's going to stop the market and then give a reaction, because there's 300 US dollars to buy it more, so it causes the market to rise a little bit. So after that 300 sell off, they let the market low and stop buying, and then the sellers come back in again, because everybody that missed this large move right here and seen this large candle, which most people think, oh, we in the seller's market. The market is going to go down. The market is very weak. Let's jump in before we lose out. And that's when most people jump in down here. See, because with VSA and knowing your supply and demand zones, you won't do that, because you know that this increase in volume with this bullish reaction and this demand zone, which was drawn from another demand back here on the board, which you can't see, you know that you're coming into a zone where buyers is at. And plus the volume is telling you, yes, there are some buyers there, because we do not have another sell candle coming down, which should have been, you see how long this candle is for this volume? That it should have been another candle at least half the size going down, because look at the volume here, which is even more than half the size of the volume here. So we should have a candle about 60% the size of this going down if there was some actual sellers here, if we were selling going all in this candle. No, it was more buyers than selling in this candle, though this is a downward candle. So when the market goes up, it goes up to test this retracement zone. And where? The sellers are waiting for them. And now this time I left the fib on there to show you how it works. It went right in there, tested 50%, bounced around for a lot, even though there's no supply zone back here. Yes, we have a support area right here, which we know support becomes demand, but it's not really into it. So it went back down, as you can see, come down to try to catch people in their stops and stuff like that before taking off and going up and coming right back into another supply zone where you start seeing these red candles right here. That's letting you know supply is coming into the market and we get an increase in volume. Okay, we got about 10 minutes left, people, and I would like to give y'all a chance to answer some questions for y'all if y'all have any. If you have any questions, just let me know, and I'll see if I can answer them for you. Are there any questions? Yes, okay. Yes, I do. The name of my website is printmoneymakers.com. Yes, Todd, it does sound erratic because it's probably like the first time, you're hearing it. I have videos on my website where you can actually see me doing it in the market live while the market is working. I got teaching videos on there as well, that you can go in there and see, explaining to you in more detail. It's hard to do, in a 20-minute window. Yes, it will apply to the general market, and also it will apply to a choppy market. It will keep you out of a choppy market. And there have been times I was able to trade a choppy market. Are there any more questions? Okay, the different time frame. Very good question. You must pay attention to the time frames, but the trading method is based on day trading, right? So therefore, you have to get your signals from the 1 hour and then go to the 5-minute and 15-minute for confirmation and trade entry. Yes, but you can see the same thing on the different time frames, and you will know where the supply and demand zone. In fact, the higher time frames for the 4-hour up is where you draw your supply and demand zones from. Oh, your sound is erratic. Yes, I can. Oh, sorry. Is the sound better? Sound better? Okay. I'm sorry about that. All right. I'm sorry about that. All right. Sorry about that. Yes. This method is very, very lucrative because all right, great. The reason why it's so lucrative because it shows you where the bankers are and what they're up to and what they're doing. I have 3 rules to trading, which is have proper money management, be patient, which I call the golden rule of trading, and as well as never ever predict the market. And with trading with VSA and supply and demand zones in CICR, which I call the print money makers method, you will be able to see where the bankers is placing their buy and sell orders. And if you know where the bankers is going, I'm sure you're going to follow their footsteps and do exactly what they're doing because they are the ones that's making all the money. You remember, Forex is a $4 trillion a day business. So if you can just get a small piece of pie, I think you can have that mansion in the yacht that we all trying to get. Yes, of course you can. You can do it for position trades as well. Yes, you can do it for position trades as well. And especially with the supply and demand zones, they work very, very well for position trades. Like I have position trades in, I have swing trades in, and I do day trading, because I like to trade and it's how should I say, it's a joy for me to go into the market and be able to just take out money. That's why I call it printing money, because if I want to, like, okay, I bought a BMW. I bought the new 650 with all the bells and whistles on it. I wanted the car. I didn't want to take no money out of my bank. So you know what I did? I took 1 month
and made the $110,000 that it took to buy the car, and that's what I do. I just print the money as I want to spend it. Yes, of course. We do have a trading room style. All you got to do when you go to my website, you get in contact with my business associate. His name is Scott Pulowski. His number and my number and name is in there, and you just get in contact with him, and he will set everything up, let you know what time to contact me. He handles all of that stuff. I just focus on the trading, making the money, because I figure if we do it like that, my head to be clear to do what I need to do, his head to be clear to do what he need to do. So that's how that works. Yes, we have a trial period. You can actually come in, follow me, making trades during the day, make you a little bit of money, and just see if it can work for you. Yeah, I thank you a lot, Glenn. I'm so nervous. I never done this before, So thanks for the thanks. I appreciate it. I thought I was doing a bad job. All right, thanks, Pete. Thanks. Really? Wow. Thanks, Gimme Theater. Yes, you can contact me. Okay, listen. On Facebook, just look for Chuck Williams, right? Here's my email. And this is my business partner. I was telling you, named Scott. Pip Traders 911. Okay, I think it's at Yahoo. This is his email, so you can contact him there. Let me see, and then you also can go to the website, which I would put up again, moneymakers.com. You can go there. Okay, so is everybody satisfied with what you hear so far? We're gonna be doing another presentation. I'm gonna have another webinar. Thank you, Morgan. Thank you so much. Thanks, Toby. I'm gonna be having another webinar. I think it's on the 20th. But whenever you contact me or either Scott, you will hear, the definite date that we're going to have it in time, so you can sit in again, and probably get some more information. But if you come to the website anyway, you're going to be getting taught, anyway, how to do this and how to do it effectively, where you can win 9 out of 10 trades that you take. But if you do bad in using this method, you're going to be winning 70% of the time. So even when you're doing bad, yes, even when you're doing bad, you're still going to be profitable and be able to get that mansion and the yacht that you want. Okay, well, in which picture? In which picture, Jeff? You mean on Facebook or a home page? None of them is us. We just put that there. But then again, Scott just did over the site earlier. Well, he just did over the site earlier, so I don't know if he put some pictures of us in there or not. I haven't seen the site today, because he was doing that when I was trying to prepare for this presentation. So he was telling me he was cutting some pages and changing the home page and stuff like that. So I don't know. It might be some pictures there. I got to go and see. I don't know. I know we had some other pictures there that was of some other people, that look kind of business oriented. But I got like 30 more seconds before my presentation is over. Is there any more questions I can answer for you?